pause 1 second for on you, Erlend, just because you have a banking background, but you know, your fellow panelists here are working for banks, and your Oceanis is a little bit different. So, just would you just take a quick moment just to explain what Oceanis does, and you know, as far as ship finance?
Of course. Oceanis acts as a platform that hosts lenders, and ship owners can come to Oceanis and get access and guidance and advice on how to get financing from the various lenders on the platform. So in a way, Oceanis acts as an intermediary. We do not provide the funding ourselves, but we work with all sorts of capital available for ship owners. So that is bank financing, leasing houses, alternative debt, and so on. Really covering the wide spectrum of available debt finance.
So you really have a unique perspective on a lot of deal flow, I think, these days.
Yeah, that could be said. Yes, we see the whole spectrum really of asset-backed lending.
Great. And I understand from talking to you last night, you have a panel of 45 lenders that are members of your platform. Any of the lenders on this panel part of your platform, or hoping that they'll be?
Yeah, we so the institutions represented by these gentlemen, 3/4 of them have been in contact with us. So we 50 actually, not 45 anymore. 50 lenders.
Thank you. So we're talking about the evolving landscape of ship finance, and I mentioned in the introduction, you know, with rising interest rates and increasing inflationary pressure. And a question really for the group, I'm just curious, you know, are you still open for business today, or are you going to keep capital on the sidelines and take a wait and see approach? And Philipp, maybe I'll start with you since you're to my immediate.
Yeah, right. Thank you. I think the inflationary problem or challenges is not that much of our key concern at the moment. Obviously, we have to look at OPEX budgets and whether we calculate it right within the projects we have. But I think for those with the rising markets, the deals we did in the last 2 or 4 years, you know, they are in a good shape. So we have low risk, and also we have always calculated enough reserves there. So I think there we feel comfortable. With regard to new business, obviously, we see more clients of ours becoming, let's say, a bit more selective on what they show us, as not everything calculates. And also, let's say, deals where you buy a ship with a charter attached are obviously more difficult to justify in an environment where maybe your OPEX or other costs have risen dramatically. This would be my initial thoughts to this.
Thank you. Michael?
I don't really think inflation interest rates matter directly. I mean, we hope obviously inflation will come down reasonably quickly once energy costs come down. I think the question is really whether the impact on consumer demand is significant enough to lead to an overcapacity of ships, but I don't think that's the case either. So, and we don't see a new round of ordering being triggered other than really replacing container ships and some LNG vessels. So I think we're all open for business. The question is, what is the business to do? Because part of the problem is that most sectors of shipping have actually had 2 very good years and have been paying down debt. Rough total of senior debt outstanding is around 300 billion, and that's probably up a tiny bit in the last year or so, but it was about 600 billion before the crisis, you know, when all of Philipp's fellow German banks all disappeared, if you like. So I think it's a case of deals are getting done, and actually pricing has become more competitive in some respects. But I don't think the demand for capital has recovered yet, and that's a good thing in some respects because ship owners have been earning money and they've actually used a lot of that to reduce leverage. One of the key things for this industry historically has been high leverage, and that's caused a lot of problems. So lower leverage is where shipping needs to be, and that's, so we're sort of in a normal state of affairs. But at some point, when we go into the issue of new technologies, the capital needs to be redeployed to invest in the new technologies.
Evan, a different perspective?
No, not really. Picking up on what both Philipp and Michael said. So there is no immediate direct impact on us as lending institutions. So there's still the demand for capital, but indirectly on the OpEx level. So we see owners start to suffer crew wages and availability of crew. So, and on the new buildings, on the asset values themselves, they're expensive, and they're looking to their traditional lenders to finance that. And we look at, is this a high value, a high price to pay for the asset? So it starts to impact our clients more directly than us, but it affects how we look at the business.
Christos, how about D&B?
Well, when it comes to uncertainties in the market, when it comes to interest rates rising, I think we've all had excellent training working in shipping and in this extreme volatility, so I don't think it really impacts us. The questions we are trying to answer, and Michael alluded to it, is there are technological changes coming. How do we position ourselves? What roles do we play? That is something that we spend a lot of time on. But no, the fundamentals of the majority of the shipping markets are positive. We see strong markets on the tanker side. The dry market will recover as soon as China starts opening up. I think with containers, we've seen the cyclicality. Most people have been cautious. Gas has really exploded. So it's good times. We see good projects. We are there for business. And the issues that we are challenging ourselves with has more to do with technology and change rather than volatility, which we have gained a lot of experience in over the years.
Thank you, Christos. And Erlend, have you seen the deals that owners of your platform are putting forward? Are they changing in some ways to address these issues?
Yeah, no, definitely. The inflation, of course, leads to higher interest rates, and we calculate all projects also on the equity side, and we see a lot of business cases actually starting to disappear based on the increased interest rates. So, of course, we look at what would be the opportunity on the equity side, and just over the last 9 months, we've seen the economics totally shift, and a case that if they would have invested last winter, would actually make rational sense, but now if you lock in the interest rates, it's no longer a viable business case. This refers to new building decisions. So, as you would expect, with increased interest rates, you decrease investments, and we already see that happening.
On the other side, to add to that, what we can observe, and I think this is a good news for the industry, is that the cash side of things is really has really increased, and obviously due to the good shape of the market in most of the segments, if not all at the moment, has led to really cash being piled up on accounts, and this is not spent, is not invested at the moment, as we I think touched on here already, in the sense that new technology is still uncertain, or there are uncertainties regulatory-wise, technology-wise, and so people are waiting. But this cash remains on the accounts to be invested later. So I think that the major topic we will have for the next 2-3 years is when you start ordering, when you start to reinvest, to be there then, to be prepared. And I think we all prepare ourselves in different ways with regard to ESG and other challenges we have here.
If I could pick up on that, I agree with Philipp, but I think the other thing is when CII comes in January, then the issue of retrofitting ships also comes in, and so a lot of those technologies where some owners have held back, they will be forced into spending some of that money on retrofitting old ships in order to get the right ratings. So I don't think we should see it as nothing is happening. A lot is going to happen, and retrofitting is where most of the money is going to go in the next few years, rather than on ordering old technology new vessels.
Thank you.
Which is why it's good that ship owners are in a strong liquid position.
And touching on that, ship owners are in a stronger position. you know, I've heard they're repaying loans back a lot earlier, you know, causing banks to have to consider like redeploying capital. Is that like a bit harder to do? Is it harder to find those deals that, you know, do we turn that money around? Philipp, maybe a question for you.
Yeah, okay. I think you're right. The first half was very much about early repayments. Obviously, many took profit of the market in container, but also in bulk. And we have seen, let's say, a very busy first quarter, less busy second quarter. I think everyone was a bit puzzled by all the macro uncertainties with the war, with the sanctions. So very operational, so less new deals, and since summer break is over, we see more deal inquiries on the table. So I think net on net, it's a year where we basically equal repayments and new deals, at least for ourselves. So this is the picture for now.
Evan?
Yeah, it's actually very similar. So, but give some color to it. I have never seen this level of prepayments. One level, it's good because you like to see your clients, your ship owners making what you think are smart decisions. Okay, you don't need the debt. You have so much cash. Repay the debt. On the other hand, I also have a job to do, like people to borrow money. So it's probably close to what Philipp mentioned. We probably will see the same amount going out and coming back in this year. So net on net, not too much of a move. We're still finding good business, but we have more coming back than I've ever seen before.
Christos?
Bankers are never happy. We typically give our clients a hard time because they're over-levered, they don't pay debt down quick enough, they don't manage their balance sheet. Now they're paying down, we don't like it either. I think it's a very good thing that companies are using this opportunity in these strong markets to bolster the balance sheets. I think that is very good. The cash flow that is being generated, they can use in various ways. I think we're going to see more consolidation as companies get stronger. That's a good thing. And you will see different opportunities there. There's always ways to put in place a smarter capital structure, a more efficient capital structure for companies. So I think it's a net positive that we see companies resulting to healthier balance sheets.
Erlend, in your in an advisory role, do you ever help ship owners decide whether or not to repay early or keep those loans working? Or
I think that for everyone in ship finance, this is obviously positive, high velocity in this industry. When it creates a job also on the financing side, all the banks work at all cylinders just to try to keep their book constant, and that's positive, of course.
One of the ways that to keep capital working is especially with alternative debt providers coming into the market, is maybe senior lenders taking a position on the back end of financing, providing financing to the lessors. Do any of Philipp, I think you do that, some of that type of financing. Do you, with the historically high charter rates, is this more of a challenge, or do you have to be more cautious about that?
I think that is not so much the question. In the end, for us, it's an interesting field, as these alternative debt funds are professional market participants. So it's a very rational discussion on things, and this back leveraging or this fund level financing is something where we feel comfortable as you finance a portfolio of vessels or back lever loans which they provide to the industry. So I think this diversification effect is playing out positively here, especially if you have, let's say, experienced asset managers or alternative debt fund managers behind that. So I think this is an attractive field. I think the major challenges here are rather on the compliance side for let's say senior lenders, for regulated banks. It's obvious to make the KYC compliance checks where these let's say alternative debt providers have a bit more room to maneuver into jurisdictions which senior lenders normally may not touch these days. So this I would consider to be the major challenge rather than target rates or asset values.
Evan, do you have?
No, I very much agree. That is an important part of our business, CIT. So we have a third of our business is supporting alternative lenders. So the people you all know, the Intrust, the MAPs, the Northerns, and quite a good business for us. And we in fact work together. We Philipp on one, jointly providing back leverage for one of the lenders. So.
Thank you. I guess just one last question on keeping your capital working. As far as deal size, for new deals, would you consider keeping your money? Would you look to be part of a larger transaction, or will you just stand alone in providing these new financing? Any particular sweet spots or thoughts on those types of transactions?
No, we're pretty flexible on that. So for us, in terms of deal size, it's 35 to 40 million. We're happy to partner with other lenders to do that. We're happy to do it bilaterally. Where we're less flexible is on the asset type. We're focusing continuously on the main liquid asset types, the tribal container ships and tankers. That's what we know a little bit about, and we stay there.
Christos?
I mean, our business model and our focus is more towards the more sophisticated end of the spectrum. We will do bilaterals, we will do club deals, but where we really make a difference is big syndicates, big underwrites, bridge to capital market transactions, and what we focus on is the amount of capital we can make available to our clients, not necessarily how much we can keep on our balance sheet. We like to turn our capital quickly, and we just focus on what's the most efficient way for our clients to access capital. It could be our balance sheet, it could be the capital market, so it's a mix. It's a mix.
Michael, the same for Citi, or?
Well, it's really about return on capital. I think the Fed imposed an additional 1% capital buffer on the big US banks a few months ago, which was unexpected, and that puts stresses on capital and returns, and we're all fighting for a share of capital in our institutions, and so it doesn't, we do bilaterals, we do syndicated loans, but ultimately it's about returns from the relationships we have with those clients. I think in terms of sector, there's an inevitable issue of emissions in the sectors. The elephant in the room, if you like, is we're all going to be measuring emissions, whether you're part of the cycle principles or not, because all bank regulators will insist upon some form of that, and of course that's been formalised. It's sort of interesting thing. Think of all the things that have happened since we last met in this room, and the significant ones are the Net Zero Banking Alliance, the commitment to 1.5 on a sustainable basis by those signatories, and that's $130 billion of capital to go to decarbonise industry globally. Shipping is obviously a part. And so there are decisions, and again, as I said, CII, EXI coming in January, we're going to change a lot of things en route to what we finance being around the cash flow generated from those assets. And it isn't about the freight rate that the owner charges, it's going to be about that and the emissions of the vessel. You already see the commercial decisions being made by sea cargo charter members around whether they'll charter a vessel or not because of the history of emissions and recent voyages of that ship. So how we deploy our capital is a competition within most of our organisations, and it's going to be measured in lots of different ways going forward. And these are things we touched on 3 years ago. We just launched the Poseidon Principles in June 2019. But the world has changed, and it's only going to carry on changing. And so a lot of the things that we have been used to doing are going to change dramatically over the next few years. We're sort of in a, I don't call it phony war, it's not like that, but as the people sort of make decisions, start to feel around the decisions they need to make, particularly investment decisions for ship owners, what technology to invest in, which is why a lot are not making those decisions yet. It's going to change the whole way the industry gets financed. Not quite yet, but we have to be all in a position to be able to finance that change fairly soon. And so that's why it's a very good thing that shipping is liquid, leverage is lower, because it makes that transition when it happens much better and much more financeable.
Philipp, at Berenberg, is ESG, is that something that is part of your credit decisions? Are you writing that into your loans, those types of policies?
Yeah, I think definitely it is, or it starts to be. We are not part of the Poseidon principles. So far, Michael didn't convince me yet. But I think the reason for that is not Michael or the Poseidon principles, which I fully appreciate and understand, but as a private bank working with institutional capital, mostly from the European area, where you have regulated entities according to EU taxonomy and according to the non-disclosure or disclosure regulation from the EU, meaning that these have some specifics which are a bit different to banks, but driving in the same direction. So this for us means that we working currently on an ESG scoring, which will be part of our credit decision going forward. Always keeping in mind, and you know that Berenberg is focusing on second-hand tonnage so far. I think we have to make sure in this transition over the next 10 years that the existing fleet still has access to financing. I think this is one of the major tasks I see, and this has not become easier with these regulatory steps, especially within the EU, where you also look very much at the cargo side as defining dedicated to the transport of fossil fuel. That's the main sentence here, which makes it more challenging for European regulated banks and investors to allocate capital into, for example, everything which is tankers, maybe except for chemical tankers, and anything which is bulkers attached to coal transport. So I think there we have an issue which we have to find a way around, and we currently sound this for our portfolio and for deals going forward. What tonnage can we finance going forward, and what needs to be also a kind of bonus-malus system maybe, which we have seen already in public market transactions, sustainability-linked bonds and so on, which have now to be translated also into private credit market going forward, which will take a bit of time, but I think which will definitely come, especially if we banks being started to regulate it also with our capital, let's say, to be allocated into sustainable or non-sustainable, and then having different cost of capital for that.
Evan, I don't think CIT is a member of the Poseidon Principles either. You have a similar view of Philipp as far as ESG and
Yes, we do. So I think that's one of the reasons why Michael's in between the two of us. Michael mentioned three years ago when we last met, it was a question of if, not when. And now it's really when, it's not if anymore. This is coming into place. January, we're looking at booking deals now that have ESG components and milestones in them. Starting January 1st, when vessels are getting scored and they no longer can get chartered from Cargill because they're a D and not a B, that's going to have an immediate impact. So even if we weren't all interested in saving the planet, we would be interested in how is the shipowner going to pay us back. And if they're not compliant, we can't finance them. And this is just going to roll out. I don't know the exact timing of when the scoring is going to happen, but it is in near term, not in long term anymore. So thanks to Michael.
Well,
Christos.
I'm glad Evan said that. I was worrying that I got the wrong email address because he never replied to my email.
It's a big club.
No, the Poseidon Principles for Marine Insurance, which launched at the end of last year, they have an associate membership. Maybe we should have an associate membership for banks sitting either side of me that will automatically trigger into full membership in 3 years' time or something. And I'm glad you've said it's when, not if, because I think that's right.
Christos, yep.
No, I think we are approaching the whole matter in the wrong way. Of course, ESG is of course extremely important. We have our targets. We have our net zero ambitions. The Poseidon principle is extremely important, but it's not a necessary evil. I mean, the industry is being disrupted in a major way. So it's not I need to tick the box. I need to measure things and just pass the test. If you don't change your business model radically as a ship owner or as a shipping bank, you run the risk of becoming extinct. That is what we are trying to guard against, not to tick some box or fill a paper or put the wool over our credit committee's eyes. It's trying to figure out which are the companies that are going to survive this way, which are the companies that understand that their business is changing, it's going to be very different. Maybe the ships they're building today are not going to have a life of 20 years, and how do we structure to be survivors and to be able to back the winners on the other side. That's the key. That's why it's so important for us, not just to tick the box.
Great answer. Erlend, from your perspective, working so closely with many different ship owners, do you see, bigger or smaller ship owners, taking more or less initiative in this area, or?
Yeah, it's really on everyone's mind. So we see small ship owners trying to find opportunities here in this space, also on the new building side. So it's not exclusively on the larger corporates' mind, the whole ESG topic, because there are many opportunities, original new ship designs with transitional fuels, not only thinking about ammonia or hydrogen. We have ship owners looking into energy propulsion. So this is definitely on the mind of also the small ship owners. The majority of the traffic on our platform, as Philipp also alludes to, this is second-hand tonnage. That is really the majority of what we see. And in that space, I think what a lot of our lenders, what they think about is that they will need to be there also for this more mature tonnage, instead of creating a lot of stranded assets. That's not the best solution for the planet either, that you end up having to scrap a lot of vessels that have perhaps 10 years useful economic lifetime left. I think for a lot of people it's worth remembering that the whole transition will take decades. We know that this is not something that will be solved in a matter of 5 years. And in order to, shipping as a whole, it really supports the living of standard that everyone on this planet knows about. And if you would rush any transition here, you would materially impact the standards of living too quickly for a lot of people. And then this whole transition will lose political support. So to have some patience in this transition, I think people need to realize how long this will actually take. This is really a several decades effort that will take place, not 5 or 6 years. So really keeping political support for this over a long period, really thinking as a marathon rather than a sprint, will be in everyone's interest. And during that long phase, you also need to support the ship owners who not only look at new buildings, but have remaining mature tonnage that still serves a vital purpose in this industry.
I don't disagree that it will take a long time, because it will take probably till 2060 or beyond that for the existing fleet today to sort of finally disappear. But I think the commitments banks signed up to the Net Zero Banking Alliance is to forecast the emissions from all their portfolios, but including shipping, in 2030, and to do that by mid-24. So some banks are already going through that process of having to commit to emissions from their shipping portfolios in 2030, and that means making decisions now about the type of things they are financing. Clearly there'll be evolution in terms of the technological development in the transition and retrofitting that will reduce those emissions. The key decision for shipping made at the COP26 in Glasgow was the Clydebank Declaration, committed now 25 governments, including the US, the UK, most of the major European countries and many of the Asian countries, is to create green corridors. Now these will, and the key thing about that when you read it is it's not some aspiration by 2050, it is a commitment by governments to create the frameworks for green corridors within 5 years. And you've seen lots of announcements about port-to-port stuff. But those green corridors will come into existence within this decade, because by 2030, and there's not much disagreement around this, if you read DNV's latest forecast, if you look at the transition strategy published by the Global Maritime Forum, 5% of all fuels have to be zero-emission fuels by 2030 if shipping is going to meet its Paris Agreement, its participation, if you like, in reaching Paris Agreement. And so, of course, a lot of the existing world fleet today will still be in operation in 2030, but it will have to have lower emissions through the retrofitting. But by 2030, all investment will be in zero-emission ships. I think the risk of stranded assets, frankly, is quite low, but it'll take, whilst it will take 20 or 30 years after 30 for the whole fleet to change, every decision will be geared to net zero, 1.5, whatever you want to call it. And so that is within this decade. And so all the investment decisions made in shipping by investors, by lenders in the next 7 years, by the end of that 7 years, it will be only one way. Now, it doesn't mean that, of course, ships that are rated D and E under the CII won't still exist in coastal trades in some countries and things. There will always be that. But I think the key other thing about shipping is when they define Scope 3 emissions, every other industry, their supply chain, is determined by what the emissions are from shipping. So there's a vested interest in consumer companies, in the oil companies, the commodity companies, in actually lowering their shipping emissions, because their own Scope 3 emissions will also reduce that way. So it will take a long time before we've replaced the whole fleet, but I think that key decisions around that are being made now and will only accelerate in the next few years.
I think one of the other ways that you can have a positive impact on the environment, at least I've seen in the press, is buying carbon offsets to have like a carbon neutral voyage. Is that part of anyone's credit decision, or is that more like marketing of ship owners to charterers to?
I think it's not yet part of our credit decision making, but at least we carefully observe the installation of this ETS market, which will come into force by 2024, and which will then create a situation where this industry starts to be part of this trading activities around certificates. Yeah? And I think also for that, maybe it's worth to consider banks to be part of that, as we are efficient traders in FX in all kind of currencies for you. Why shouldn't we be also supporting your efforts in this respect if you have to sell, buy, or whatever? But the first step needs to be that you become aware of what is the emissions you have to buy in, or whether you have let's say a better than planned outcome for that. So I think this is something where there's an early another area of early education of all of us, but this will come into force and it will be implemented rather sooner than later.
Anyone else have a view on that, or Philipp's answer is on point? I don't know if anyone wants to touch this question or not, but sanctions is a big thing these days. Are there any sectors that maybe you're not willing to get involved with as far as lending or particular transaction types?
Yeah, that's pretty binary. There are sanctions, and we do our part in enforcing them. So we have 24/7 real-time monitoring through various services. We happen to use Purple Track, and that's an important part. And if someone is calling on a port in Venezuela, we're touching base with the client and finding out what cargo they're carrying and why they're there. Okay, the third time they're carrying the same cargo of grain, they get a little tired of our phone call, but that's something that's non-negotiable.
100%.
Yeah, no, I had understood that a lot of banks these days have vessel tracking software, so they're keeping a close eye on the ships that they're financing. I guess another question, and it may be a little bit different, is coming out of the pandemic and looking at the evolution of ship finance. Has your work areas changed dramatically? I know we're probably back in the office somewhat. Or is there a decision for all of us to come back? Has that impacted how transactions have gotten done over the past couple of years in any way? Throwing out Christos.
Most of our work is done on the road, so not much change there. But when it comes to policies, yes, we have implemented flexible working hours. People are working from home when appropriate. And we see that this works. It works well. Particularly when you have global teams, it increases the frequency of communication. You have more direct access to people. It does not replace personal contact, of course, but it's a useful tool.
Thank you, Christos. Michael?
I think that the language has begun to change, and I would expect most large institutions to have most people fully back in the office by the beginning of next year. I look around me and I look at my fellow panelists, clearly not wearing a tie for 2.5 years. I've got used to it, but I apologize for being underdressed in this room.
No, I can only confirm it's good to be back. We are all back in the office basically, and it makes sense, especially the creative part of things, discussing things early on and being also faster than in decision making, putting out indications or term sheets for you. I think there's a lot of aspects, and all the topics we discussed here need a lot of, let's say, also brainstorming activity. And brainstorming activity through video,
There's one important point, I think, there about what we did during the pandemic in shipping through Zoom. The acceleration of the whole issue around decarbonisation would not have happened as fast if we hadn't had the pandemic. Because what we were able to do in things like the Getting to Zero Coalition and all the other workforces, if you like, was to bring people together who would not normally appear at the same conference together. They wouldn't fly to the same meeting. And you were able to bring people into a discussion about the topic today on Zoom, rather than over a period of 2 or 3 years when you happen to persuade people to go and talk to them. And that was actually incredible to watch, and I think that has accelerated the progress we've actually made. We know that you can't make relationships through Zoom, and that's why getting back together is so important. But I think we also learned that using the technology that became available is a valuable tool in other respects, and that's been very important.
Great point. Erlend, thank you for that question that you let me present. Do you have any thoughts on that? Or?
I completely agree with what Michael said here now, that the pandemic has really accelerated the adoption of these digital tools, and they don't replace physical contact, but just the fact that you can have the initial meeting digitally, make sure that really enables you to accelerate these business development processes, and you can have the initial meeting. Later on, of course, you can fly and meet, but it really really accelerates the speed of these processes in our view. And for Oceanis, it's been a bit of a blessing in disguise, to be frank, with enabling these tools to be adopted worldwide.
Evan, last thought, since we're out of time?
Sure. We were very fortunate in a way. We're a relatively small team, and we can continue doing our work from home for 2 years. So we could continue, what we could do, we could continue working together, we could still grow our business. What we couldn't do is the face-to-face that you really do need as you have new members to the team. And as Christos alluded to, you really need to see the clients. So you can go 18 months without seeing your clients in person, but no, can't wait more than that. What we don't miss is a 3-hour commute every day. So going back to that full-time, we'll go kicking and screaming, but we will be back more in the office.
Thank you. Thank you, Nicholas.